You have worked hard, built up your savings and investment portfolio, and now you are counting on them to fund your retirement. But what if I told you that there might be a problem in your plan? One that could potentially put your retirement at risk. In this video, we will break down the potential pitfalls in your retirement plans, why relying on investment income alone might not be enough, and what you can do to build a more secure and reliable income for your golden years. Now, when it comes to investment portfolios for retirement, there are generally two main types. The first one is a growth or accumulation focused portfolio, something like the S&P 500 or a globally diversified ETF that automatically reinvest dividends. The goal is to let your portfolio grow over time, and once you retire, you gradually sell down your investments to fund your living expenses. The second is an income-focused portfolio, which is usually made up of dividend-paying stocks, REITs, and sometimes bonds. So instead of having to sell assets, this portfolio will provide you with a regular stream of income, thus allowing you to live off the dividends without having to touch your capital. So which is a better portfolio for retirement? Most people can tell that the accumulation-focused portfolio comes with market volatility risk. During a downturn, you may be forced to sell investments at a loss just to cover your expenses. This not only locks in losses, but also reduces the amounts of capital available to recover and grow. Over time, this can significantly shorten the lifespan of your retirement savings. This is also known as a sequence of returns risk, where if you very soon experience a major market downturn in the early years of retirement, your portfolio may never fully recover and you could end up running out of money during your retirement, even if average returns over time look decent on paper. In contrast, someone who experiences the same downturn later in retirement faces a much lower risk of depleting their assets, even if the drop is just as severe. Here's a real-world example that shows just how dangerous this risk can be. Between 1966 and 2000, an investor with a 40% equities, 60% bonds portfolio would have reasonably expected to earn an average return of 8.1%. Based on the popular 4% withdrawal rule, this should have been enough to comfortably last through retirement. In reality, the portfolio performed even better, delivering an impressive 9.5% average annual return. But despite the stronger performance, the portfolio still ran out of money before the end of retirement. Why? Because during the early years of retirement, inflation in the 1970s and early 80s was extremely high. As a result, the retiree had to withdraw more money in order to maintain the same standard of living. Those higher withdrawals, combined with market volatility, drained the portfolio much faster than expected. This shows that even with strong long-term returns, the order in which you experience those returns and inflation can make or break your retirement plan. That's why many people are drawn to an income-focused portfolio for retirement. The logic is simple. If you only spend the dividends and leave the capital untouched, then in theory, you will never run out of money, right? Well, in a way, that's true. That's because dividend payouts are typically a lot more resilient as compared to market returns. For example, if we look at the last 5 US recessionary periods, while earnings per share has fallen by an average of 42%, dividend per share only fell by 8%. Not just that, dividend payouts were also a lot less volatile than earnings growth, thereby providing investors with the cushion that they need during recessionary or low growth periods. However, what many people may fail to realize is that even if dividends are less volatile, they are still volatile, especially when you account for inflation. For example, if you look at rolling 30-year periods from 1900 to 2019, your real income, aka the income after adjusting for inflation, could vary significantly depending on when you retire. In the best case scenario, as shown by this green line here, your inflation-adjusted income could range from $5,000 to $11,000. But in the worst case scenario, if you happen to retire in the 1960s where inflation was very high, your real income might drop to as low as $1,800 to $2,500 a year. And that is a huge difference. So in some months, you have a lot of money to eat cai fan with fish. In other months, you can only eat cai fan with only fun. Here's another example. Between 2005 to 2024, a portfolio made up of 50% S&P 500 and 50% US bonds without any rebalancing also experienced significant fluctuations in income. This means that during bad years, you will have to either cut back on your spending or worse, sell off parts of your investments just to fund your retirement needs. And as we have seen, selling during downturns can be damaging to the long-term health of your portfolio. That's why having a steady stream of income, especially one that is less sensitive to market swings, can be such a game changer in retirement planning. If you are someone looking for lower risk, stable returns, or simply want to diversify your investments, you might want to check out the Income Plus category on Moomoo SG. You have probably heard of Moomoo's Cash Plus, but the main difference between Cash Plus and Income Plus is that the funds under Income Plus can potentially give higher returns. These funds primarily invest in bonds and certificates of deposits, assets that typically have low default risk and volatility. According to Moomoo's historical data as of February 2025, the maximum drawdown of the Income Plus products listed on their website has not exceeded 0.3% over the past 2 years. To check out Income Plus, just open the Moomoo app, tap on Discover, then Wealth, and scroll down till you see Income Plus. From there, you can tap on any fund to dive deeper into the details. New users who sign up to Moomoo SG get to earn up to $820 worth of welcome rewards when you fulfill the terms and conditions. Plus, enjoy zero commission for US, Hong Kong and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. Wow, like that, how to retire? Thankfully, this problem can be fixed. So what JP Morgan suggested is to do dynamic withdrawal, where instead of blindly withdrawing 4% from your portfolio every year, you have to change your withdrawal rate depending on your portfolio performance. For example, if the annual return is below 5%, you keep your withdrawal amount the same as the previous year. And if the return is between 5 to 10%, you can increase your withdrawal by the rate of inflation to maintain your purchasing power. Then if the return is even higher, you can increase your withdrawal by inflation plus an additional 3%. This strategy sounds good until they point out that this strategy is only for illustrative purposes and may or may not be successful during other periods, which is like God say but no say. So here are 2 other retirement income strategies that you can use instead. The first strategy is called the Flooring Retirement Income Strategy. It starts by identifying the minimum income you need to cover all your essential expenses, things like food, transport, utilities, and healthcare. To fund these necessities, you rely on guaranteed income sources such as CPF Life, fixed income, annuities, or government bonds. These will provide you with a stable foundation, ensuring that you can always afford your basic needs, no matter how the markets perform. Then, once your income floor is secured, you can use non-guaranteed income sources like investment drawdowns, dividend payouts, or rental income to pay for your discretionary spending. This can include things like dining out, holidays, or hobbies. That way, if the markets do well, you have more money to enjoy. And if they don't, you can cut back without affecting your essential spending. The great thing about this strategy, especially for Singaporeans, is that more than half your expenses may have already been covered by your CPF payouts. That's because if you are able to meet the full retirement sum, the monthly CPF life payouts will generally be enough to meet the basic needs of a single elderly person in Singapore. Or in other words, a large part of the heavy lifting has been done for you already. From there, you just need to plan for the remaining expenses through personal savings or investment income. But wait, isn't this a little too simplistic? After all, if your essential spending is covered by fixed income like CPF Life and government bonds, how do you account for inflation then? So what studies found was that there will generally be 3 phases during your retirement years. Initially, when you first retire, you will tend to be most active. This is often referred to as the go-go years. So you go for holidays, start new hobbies, or do discretionary activities. Then, as you age and settle into a more routine lifestyle, your discretionary expenses will tend to decline. This is the slow go years, where you will travel less, spend less, and you'll mostly be Netflixing and chilling at home. Or for the Akong and Ama in Singapore, probably watching some MediaCorp channel at home. Finally, when you are late into your retirement, your expenses will go even lower. This is known as the no-go years. However, it is also during this time where all your health problems will start to come out. You might have higher medical needs, require long-term care or assisted living, and as a result, your retirement expenses tend to go back up. So what JP Morgan found was that households which have a net worth between 205k to 750k generally follow this trend, where as they age, their overall spending gradually declines, while their healthcare spending slowly goes up. Here's another chart, but for households that are in the $1 million to $3 million range. This time, they have data for people who are in the 40s as well, and you can clearly see that there's a drop in spending during their retirement, then rises slightly near the end due to healthcare spending. So what this tells us is that yes, while inflation is a real concern, most retirees tend to spend less over time as they simplify their lifestyles and naturally cut back on discretionary expenses with age. This can help to offset the rising costs from inflation, especially in the middle and late stages of retirement. So in short, having a stable source of income to cover your essential expenses in retirement is often sufficient, especially if you are adequately insured with a hospitalization plan and a CareShield Life to handle medical costs. So that's the flooring retirement income strategy. It is easy to understand, simple to implement, but it isn't perfect. That's because once you have locked in your income floor, whether by topping up your CPF accounts or purchasing annuities, you will effectively give up access to that capital. This can reduce your financial flexibility, especially during unexpected expenses such as rising healthcare costs or emergency situations. Additionally, the funds used to secure stable, guaranteed income are typically not invested in growth assets. As a result, you limit your long-term wealth accumulation potential, which may impact your ability to meet larger discretionary goals or leave behind a legacy. Because of that, some people prefer using another retirement income strategy called the time bucket strategy. This strategy sounds super cheap, but it's actually quite intuitive. In fact, you may already be using this in your everyday life even without realizing it. Essentially, the idea is to divide your retirement savings into different buckets based on when you will use the money. Here's how it works. First, you have an income bucket. The goal of this bucket is to cover all your short-term needs over the next few years, such as daily expenses, emergency savings, or any short-term goals. The funds here are kept in very low-risk, highly liquid investments, such as money market funds, fixed deposits, or short-term bonds, such as the Moomoo Income Plus, which offers bond funds, or Cash Plus, which offers money market funds. By maintaining enough funds in these buckets, you will protect your lifestyle from market volatility over the next few years, so that you are not forced to sell your investments during a market downturn. Next, the second bucket is called the defensive bucket. This bucket provides steady, reliable income over the medium-term horizon. Here, you might want to invest in dividend-paying stocks, REITs, long-term bonds, or any assets that can generate consistent cash flow while still preserving capital. And lastly, we have the growth bucket. As the name suggests, this bucket is focused on long-term growth, where the goal is to outpace inflation and maintain your purchasing power over time. You can invest in equities, growth stocks, and any higher risk, higher return assets. While this bucket may experience short-term fluctuations, it can potentially deliver strong returns over the long run. So the way you use these buckets is that you primarily draw income from the income bucket. Then when it gets low, you fill it with funds from the defensive bucket. And as needed, you replenish the defensive bucket using gains from the growth bucket. By doing so, you get to manage your risk, maintain your desired asset allocation while getting a consistent income throughout your retirement. However, just be aware that this strategy isn't perfect either, as it requires ongoing monitoring and rebalancing. And unlike the flooring strategy, the bucket strategy doesn't offer guaranteed income for life. So at the end of the day, the best strategy is the one that fits your lifestyle, goals, and risk tolerance. You can even combine elements of both the bucket and floor strategies to build a more flexible retirement plan. Anyway, that's all for this video. Hope you found it useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.